Okay, so once again, welcome back. We are going to be taking a look at the very last chapter of this accounting class, which is going to be the closing process, right? Why am I introducing it to you now? Because in this case, we are very close to ending our accounting period for Coffee Cafe. So this is definitely something I want you to know ahead of time because right around the corner, we're going to actually start going and initiating the closing process to accounting, and that will pretty much end the accounting class here. Okay, so again, let's remind you what those 10 steps of the accounting cycle are, right? Step 1 is to collect the source documents. Step 2 is to analyze them, right? Then step 3 is to journalize it, and then step 4 was to process them into the ledger. Okay, so throughout this entire time of Coffee Cafe, this is exactly what I've been teaching you how to do for the last 4 weeks of Coffee Cafe, right? So this is where the closing process is going to start off showing you the rest of the accounting cycle, which is steps 5 through 10. Now notice this. For step 5, we have the unadjusted trial balance, okay? Now we have been doing weekly trial balances, so step 5 was a partial thing that we have been doing. Now, in this case, right, what's the difference between a regular trial balance and an unadjusted trial balance? So usually what happens is you don't typically do a trial balance until the very end of the accounting period. The reason why I have it done for you guys every week is just to keep track and make sure that you haven't been making any mistakes along the way, especially because you guys are beginner accountants, right? This is the time in the place for us to learn from our mistakes and to also be able to see where the things line up and everything matches up. So in this case, we have been practicing the trial balance, but what usually happens once you finish your end of the accounting period is you must complete the unadjusted trial balance, meaning you're going to do a trial balance with all the balances that you currently have, right, before adjustments entries are being made, okay? And then we'll go from there. So again, starting with the unadjusted trial balance at the end of the accounting period, we're going to take a list of every single account that exists in our ledger, right, that has an account balance. If it doesn't, then we choose to ignore it, right? A zero balance would not affect a debit or a credit in any way. But in this case, what we're doing here is we're testing to see if we did the accuracy of our accounting by ensuring that when we did our debits and credits and using that kind of system, that we correctly placed our debits in the correct accounts and placed our correct credits in the correct accounts, okay? So again, if we match at the end of the trial balance, which is our total debits matching our total credits, then we can go ahead and move on and proceed to the next step, which is going to be step 6 and including step 7 as well. Well, step 6 is to do your adjustments. Okay, so throughout this entire 10 weeks of class that I've been teaching you and teaching you a few things here and there, right? I taught you how to do periodic inventory conversion. That is an adjustment entry. Why? Because it happens at the end of the accounting period. Hence, that's why it's called an adjustment, right? We don't do it until the very end of the accounting period. So I've taught you how to do periodic inventory conversion. We also talked about depreciation, right? You only depreciate your assets at the end of a given accounting period or at the end of the year because we need to find some kind of way to represent that we use our machine and our equipment. So therefore, I've already taught you how to do that. Supplies expense, I haven't taught you how to do that, but it will be in the adjustments, right? When you buy supplies, right? A great example in the Coffee Cafe is that we haven't even adjusted how many cups and how much sugar and how much creamer we actually used when we sold our product to begin with. So that's going to be something that we are definitely going to be taking a look at, is going to look at a supplies expense. And then, of course, we talked about cost of materials, which is going to be considered one of those things. And then last but not least, bad debt expense, right? When customers owe you money And you have to assume that because you allow your customers to owe you money, that there is a risk that you potentially might not be able to get that money back. So again, that is considered an adjustment as well, because again, if you're waiting for a customer to pay you back and it's been 6 months, usually typically at the end of the accounting period, you'll end up writing them off as a bad debt. Right? So once we've done all those extra journal entries here for the adjustments, right? The same thing, because it's a cycle, right? Once we do our journal, we have to post it to our ledger, and then we do an adjusted trial balance, okay? Okay, so A-N, not A-U-N, okay? So unadjusted trial balance. So that's what you're going to do. So after you've been doing your adjustments, now the key part there is to test to make sure that when you did your adjustments, that you properly took them out from one account and you transferred it into the correct account. So in this case, your supplies will be credited to your supplies expense account, right? Your bad debt will be credited to your allowance for doubtful accounts or your bad debt expense, right? And then, of course, your fixed assets will be transferred to your depreciation expense account. Right? We want to make sure that those numbers do go in perfectly, okay? So we're going to run an adjusted trial balance to test to see if you correctly transferred from one account to another, all right? And once these two match, then we could go ahead and proceed to step 8, which is going to be completing the financial statements, okay? Now, the financial statements is going to be mostly derived from the adjusted trial balance, okay? All right? Now, other parts that you may or may not need, especially for the statement of cash flows, is you may need the unadjusted numbers for things like your fixed asset. So for most of the financial worksheets that you complete, they're all going to derive from the adjusted trial balance. So that's why it's important that you complete one step after another, okay? Now, as you remember, the financial statements must go in a particular order, right? Because each statement is going to be reliant on the previous statement that you've completed. So for this instance, right, the very first financial statement we're going to be working on is going to be your income statement, also known as your profit and loss, okay? Your profit and loss is literally going to test this. It's going to test taking all of your generated income and subtract out all of your expenses that you had to operate the business, and also other if you have non-operating income or non-operating expenses, all of those are going to be combined. So all of your income is going to go be subtract against all of your expenses, okay? So this is how it looks. We're going to start with our sales, right? Because that's our main core of operating income. And we're going to subtract out the cost of goods sold, which is directly related to the sales here, right? That's the expense that is directly correlated to that sales. Okay? Once we've done that, then you're going to get what's called a gross profit, okay? A gross profit or gross income, whatever it is, right? Once you get that number, then you're going to calculate and subtract every single expense that you generated in the business, right? Or not generated, excuse me, that you had to occur throughout the entire time that you were operating your business, okay? If you have a positive number, that means you generated income. If you have a negative number, you unfortunately took a loss, okay? Now, don't be sad if the first months of profits came out to be a loss, because that is very typical for any kind of business that is starting from scratch, right? You won't then generally see income until maybe 3 or 6 months after you've been running your operations, right? Because just getting your business started, getting all the supplies that you need, getting all the materials that you need to set up your store is going to be, in fact, going to be very, very heavy on your spending before you can even see yourself make a profit. So do not be sad. Now, if you get a positive number, remember, as a sole proprietor, you have two options. You have the option to either pocket that income or you either reinvest it into your company, which is your equity, right? Now, if you have a loss, who's going to pay for that? It's not going to come out of you. It's going to come out of the company. So in this case, at the end of the day, whether you have a profit or loss, if you have a loss, you're going to take it out from your equity. If you have a positive number, and you want to reinvest into your company, you're going to add it to equity. But if you want to take that money out, then you may do so. Okay? So again, once you completed your income statement, the next one is going to be completing the statement of owner's equity, right? Because I mentioned to you, right, if you had a positive number, you can choose to reinvest it into your company. But if you took a loss, that has to come out from your company, right? So what we're going to do is we're going to start off of what did you start out with your net income when you began your company or the date that you started the month, okay? So in this case, we're doing our accounting periods by month. So you would start out what you began with when you started out the business, right? So in this case, example, here's your $2,000. Now, because we made a profit and not in net income, we decided to add in $309.17 because we were reinvesting that money back into the company. And of course, anything that affects your equity is going to be your capital contributions, meaning did you invest more of your own money into the company? Yes or no? If you did yes, then you're going to increase your equity. If you choose to take money away from your company, that is going to decrease the value of your company. Okay, so again, that's going to be subtract out of your equity, and then you're going to adjust your equity accordingly to get the new number of what your equity should be at the end of the accounting period. So in this case, at the end of June, we have $2,309.17 for my equity. Okay, so once we get this number, right, then the next step is to go ahead and complete your balance sheet. Now, in this case, the balance sheet tests one thing and one thing only. It tests the accounting equation. Your assets equal your liabilities plus your equity. In this case, because we solved for equity from the previous worksheet, that means you just plug in your equity right here. Therefore, you need to just solve for your total assets and your total liabilities and compare and contrast. Did your accounting equation balance at the end of the given month? So this is all looking at real numbers that are coming from your adjusted trial balance. Okay? Keyword, right? That's why we have to go in a particular order. You're gonna be given the equity from the previous worksheet, from the previous financial statement. Once your accounting equation pans out evenly and they are balanced, right? Then we can go ahead and move on to the statement of cash flows, right? Statement of cash flows is a combination between your income statement and your balance sheet. This literally tests, right? It's in its keyword right there. It's in the title. It's literally looking at how much actual physical cash is flowing into your company and how much actual physical cash is flowing out from your company. So in essence, right, when we're taking a look at the financial statements for statement of cash flows, we're looking at a cash basis type of operations, right? So as we know, most businesses usually, if you are starting as a mom and pop shop, you usually would typically start your business as a cash basis, but that doesn't mean you can't just start as an accrual basis, right? Because our assumption is if we're going to allow customers to owe us money and we are allowed to owe vendors money, you're automatically running on an accrual type of business. Why? Because think about it. The net income that you have earned, you may have earned that sales, but did you actually receive money from them? not a 100%, right? For instance, Coffee Cafe, we have people who owe us money on an account, right? Our retail store people who want to order from us and order from us separately, right? Those ones are going to have accounts receivable. So we would record the sales, yes, but did we record that we actually received the money? No. So that is where we're going to be taking a look at the profit and loss or the income statement, and we're going to compare it to our balance sheet and be able to put it into our statement of cash flows. And we're going to separate it between three categories, right? You're going to have your operating activities, you're going to have your investing activities, and last but not least is your financing activities. So the best way to actually break it down for a better way of understanding this is the only thing that you're taking from the income statement is whether you made a net income or a net loss, right? That's the number one thing, right? We're going to pop that in first because that's going to be telling me how much money I have earned throughout this entire accounting period of operations, right? So if I have a positive number, it's going to be positive. If it's a negative number, I'm still going to include it as a negative number, right? Then we're going to break down the operating activities as, again, using your balance sheet. Now, your balance sheet contains your assets, your liabilities, and your equity, right? So in this case, which type or which kind of each account type are we splitting up here? For operating activities, the best way that we would treat this is current assets and other assets, as well as current liabilities, are going to be your main operating activity. Okay, so we're going to put all of those under that section there. Your fixed assets are going to be your investing activities, right? Because you purchase equipment for a reason, to add value to your company, but also to invest into the operations of your business, right? So that's why we're going to separate your fixed assets into the investing activities. And then last but not least, the financing activities will be any long-term loans, right? Because long-term loans is essentially you financing your activity, right? You're borrowing money for the business. Other things too is going to be your equity, your anything that affects equity. So again, any capital contributions, any owner's withdrawal will affect your financing activities. Okay, and what we're going to do here is we're going to have to actually break down each and every single account and determine whether you have cash from it or you do not have cash from it. Okay, so for instance, your fixed assets, right? You had to spend the cash in order to acquire the fixed asset. So that means you're going to subtract the money out from your pool of money because really in real life, you already spent the money. Okay, so that's just an example. But when we actually get to the actual statement of cash flows, we will actually work on it together and break it down for you. Okay, now the end goal here is to match up the what you began with you began your accounting period with amount of cash that you started with, and then you're also going to compare the ending balance of cash. Did they pan out equally, right? And then that's how you know how your money flew into your company and how your money flowed out of your company, right? Once we've done that, then the next step is to actually close out your accounting period by closing out your income and your expenses, right? We're closing the books because, again, like we mentioned many times before, profits, or in this case, income and expenses, are the perfect way to measure profitability. Why? Because we can never predict how much income we are generating on a day-to-day basis or a monthly business, right? Because we're constantly having new customers come in, and we're also constantly losing customers, right? Some of the customers don't want to come back, so that's fine. And we also have our continue customers, right? The same customers that come back to buy the same thing over and over again, right? but you aren't able to predict what a individual customer is going to want from you in regards to providing a service or providing products, right? You won't be able to predict that. Okay? Same thing with expenses, right? We know for a fact that if we're doing this on a month-to-month basis, we have to also manage our expenses by determining how much that we will be spending for the business, right? But you won't be able to predict that, right? Because maybe this month, July, I can put more money into marketing because it's a 4th of July weekend. Where August, there are no holidays in August. You would either have to spend the money just to say, hey, I'm going to have a special sale for fall season, right? The beginning of fall season sales, or maybe I'll even do back to school sale, right? Anything that you can think of in the month of August, right? But then you're not thinking about the comparing from the previous month, right? Because the previous month I had to spend X amount of money on advertising, while in August, maybe not so much. So that's going to be a perfect example where you're not going to have the same exact expenses occur every single time, right? There are what's called fixed expenses, such as rent, right? Usually, typically, when you go get a contract with a landlord and you're renting a specific location, generally, rule of thumb is your rent will typically be the same price for every single month. But that's only depending, again, if you've been contracted for them for like X amount of years. If you've been there for 2 or 3 years, they also can raise the price of rent, right? And of course, utilities is going to be a flexible, because it's based on how much electricity you use and how much water that you use per month. So in this case, yes, you will see some fixed expenses, but most likely you're going to have more fluctuating expenses occur. And again, these two can help us predict profitability, but also see where we are in the company, right? How are we progressing in the company, right? And it also allows us to see what decisions we can make. So how do we close out our revenues, and how do we close out our expenses? It's straightforward, right? When we talk about looking at the balance of a debit and a credit, right? We know that it's acting like it is on a number line. So if you're going to be on the left side, $200, right? How do you get to 0? Well, that means you got to credit 0, because you're going to decrease the account by the $200, and that will eventually get your account balance to 0. So basically, that's exactly what we're doing. That's how we close out our books, by zeroing out our accounts. So if for any reason, we know this for a fact, right? If revenues typically have a credit balance, how do we zero out my revenues? Straightforward. You're going to end up debiting all of your income, right? And then same thing's going to be the opposite for your expenses, right? If we normally know that they have a debit balance, how do you zero them out? You credit them. So that's exactly what you're going to do. You're going to debit all of your sales, and then we're going to place it to an account called income summary. Okay? So this one is also shared name. It could be referred to as retained earnings as well, right? This is the account that happens before you make the executive decision to either reinvest into equity or to calculate your profits before you actually put it into equity. Okay? Hence the word income summary, but it's also known as retained earnings. Right? So again, for sales, right, we're going to debit our sales and credit them to our income summary. Okay? And then once we do that, we're going to credit all of our expenses and debit them into income summary. Okay? So at the end of the day, the numbers are going to go into income summary. And what you're going to notice is your total amount in your income summary should equal the total profit or loss that you generated in your profit and loss statement or your income statement. So in this case, right, I have my total sales right there, my total cost of goods sold, and here I get a total of 309.17, right, which was my profit. And of course, after you've completed putting all your revenues into your income statement and completing all of your expenses into income summary, last but not least, if you choose to reinvest into your company, which I highly recommend for smaller businesses who are starting from scratch, reinvest into your company. It's a powerful tool. So in this case, what you're going to do is you're going to zero out your income summary to your equity, okay? So again, this is a balance kind of game, right? If you have currently a credit balance in your income summary, that means you are going to debit your income summary and you're going to increase your equity, okay? If you have a debit balance in your income summary, then you're going to end up crediting your income summary. Therefore, you're going to end up debiting your equity. So therefore, you would decrease your equity at that point. Okay, so that's the rule of thumb there is we're looking at the balances. So in this case, you're going to close out the income summary into equity, right? And of course, anything else that affects equity. So that means any capital contributions or any other owner's withdrawal, those are all going to close out to equity at the end of the accounting period as well, right? And then last but not least, you're going to complete step 10, which is completing the post-closing trial balance, where we're literally going to compare. Did you get the same answer for your equity? Okay, because in this case, you don't have any more revenues and you don't have any more expenses, right? They're all should have been transferred to equity. And if you do end up getting the same number for equity, then your post-closing trial balance should equal your total debits with your total credits. Okay, and then therefore, if that is even, then you have completed all 10 steps of the accounting cycle. And then when you start your new accounting period, you're going to start the cycle all over again. Okay? So, chapter review, we talked about the 10 steps of the accounting cycle. Why is it important to know that there's a particular order? It's because each step is affected by the previous step. So if you can't complete the previous step, you won't be able to move on forward. Okay? So it's important that you understand that a cycle comes full circle and that once you complete the accounting cycle, you're going to end up starting it all over again. Okay? And then we talked about what the trial balance does. So again, it's a list of every single account balance that is in your chart of accounts or in your general ledger, and they in your general ledger will have their respective account balances. So you're going to test if your total debits match your total credits. Okay. Here again, when we talk about the closing process, we're talking about closing all revenues to income summary and closing all expenses to your income summary. And then, of course, last but not least, you're going to close out your income summary to your equity. And we talked about the 4 financial statements. So again, here's a quick little overview of what the math is behind for each and every single financial statement and what are the key components that make up the financial statement. Okay. And they have to go in a particular order. So first one goes income summary or income statement, and then second goes statement of owner's equity. Third is balance sheet. Fourth is statement of cash flows. Okay. And of course, here are examples of adjustment entries that you do need to know, right, that we taught. Okay. So any questions in regards to chapter 13?